Good evening, friends. We'll be starting the class at 5 o'clock. 2 minutes are left now. Yeah. In between, you have any questions you may ask. So we will start this session. So we are now starting the chapter that is on sales accounting, also called as revenue accounting. Sales is revenue. So what you will hear from the accounts team, the term revenue. The term revenue is what you call it as sales. Revenue can be from manufacturing activity, can be from service activity, but can be from both the activities. Whereas sales is from manufacturing activity or trading activity. Okay, so gross revenue and sales means the same thing. Okay, so we are now in the sales return book. What is sales return? Suppose you order for 500 quantities and suppose you return 10 quantities of the 500 you have received. So this will be entered by the sales team, the sales accounts team in the sales return book. Okay, that means 500 minus 10 is equal to 490. So he will issue the invoice for 500, but he will also issue the credit note for 10 quantity. Okay, so recording in the sales return book, instead of recording in a journal, the sales return could be recorded in the sales return book or sales return inward. Sales return or return inward. What you do is when you do a sales return, sales means you do it outward, a sales return means you do it inward. Okay, so return inward, return outward, you should be very clear in this. The sales return book records the goods returned by a customer. The sales return book records only the credit sales. Uh, just a minute. I will draw this calendar for you. The sales return book records only the return of credit sales made. It does not record the return of cash sales made. So sales return only records the what you receive from the vendors. The credit note forms the basis of recording the goods, the sales return. Whatever goods you return, that will be covered by the sales return and that will be the basis of the credit note. The debit note and credit note. Debit note is for debiting the party, credit note is for crediting the party. Whereas the credit note issues the debit for the sales. So what you receive is credit note. Okay. The format of a sales return book is given below. Serial number, date, particulars, ledger folio, credit note number, amount in rupees, and the total of amount. The grand total of this is given in the extreme end. Posting from the sales return book to the ledger account will be done below. Sales to posting as per sales return book, rupees, and the entry. So suppose you receive on 9th of June 10 entries, it will have the total of 10 entries and it will have the sales return book. Okay. And balance is customer. So sales return is what you receive from the sales. Suppose you do a sales of 500 and suppose you return 10 pieces. Sales return is recording of the 10 goods. Okay. What is sales allowance? Sales allowance is a distinct type of transaction whereby the customer agrees to keep the undesirable product. That means the goods are somewhat defective. Okay, that means it can be due to bad workmanship or due to workmanship which is of different color. Suppose you are wanting the blue color and suppose the salesman has given you green color. That means you are not interested in the green color. Okay, instead of returning back for a reduction in the selling price. So you bargain the shopkeeper that you have ordered for blue of the color, but instead the green color has come. So you are requesting him to keep the quantity with a discount. So some discount is given whereby the customer keeps the goods with a discount. The value in the reduction in the selling price is debited to sales allowance account. Whatever is the cost, the reduction in the price, that is debited to the sales allowance account as it is a loss to the business. So that is a loss to the business. Okay. Sales allowances after the initial billing to the customer, but before the payment is received from the customer. Sales allowances will happen once the customer receives the good, and suppose he gives you a call that he doesn't like the product, you offer him some discount, that discount is sales allowance. Technically, two separate accounts. One the sales return, second the sales allowances are open to record and analyze the quantum of return allowances. So you will open the two accounts, one sales return, it will record at whatever the quantity is billed, and other the sales allowance, it will record the allowances, means some discount is given to the buyer. Okay, that is sales allowance is going to be debited to customer. Okay, it allows the shopkeeper or allows the buyer to keep the goods with a discount. Sales allowance would be also be reduced from the net sales in the income statement to arrive in the net sales. The treatment of sales allowance is shown as below. Trading and profit and loss account by sales less the sales allowances. Okay. Question is given to you. I'm giving you 5 minutes to solve this question. When you do it, say yes, I have done it. So question is, I'm seeing the question. A company sold goods worth 37,000 to Shri Akash. Of these goods, rupees 8,000 with goods were found to be out of specification. The company, after careful consultation, allowed a sales allowance of 5,500 for the undesired sales. Past journal entry in the books of the company also calculate the amount receivable from Akash. So you have 5 minutes to solve the question. Attempt this question. 2 more minutes. Done? Okay. So first entry is Akash debit 37,500 to sales, that is credited. Sales allowance debit 5,500 to Akash 5,500. The amount receivable is 37,500 minus 5,500 is equal to 32,000. Clear? So in the debtors ledger, you will find the following balances: opening balance plus whatever is a sale. I will show it in a debit, and the credit side will have the cash, the bank, what you call it as sales return, sales allowances, what do you call it as bad debts, discount, and the closing balance is also mentioned in the debtors ledger. So opening and closing are a must, but in between you will have the following transactions. Okay. There is one question for you. From the following, prepare the total debtors. Debtors opening, will have it. Debtors closing, you will have it here. Debtors opening and debtor closing. Cash received, you will have it here. Bad debts, have it here. Returns inward, return inward, return outward, you will have to note it down, whether it will be sales return or will be purchase return. Returns inward. Okay. That will be what it will be, sales return or purchase return. लेकिन बाबा ने जो कमाल किया, उसने पूरे देश के सियासी पंडितों को हिला return inwards is sales return. Okay, that means you will record it here. And cash sales is, you will record it here. Bad debts is, you will record it here. Complete the cash sales, gross sales. So closing is the, whatever is the closing balance, that will be shown in the balance sheet by balance CD 34,500. And total gross sales is equal to cash sales plus credit sales. Whatever is the cash sales, whatever is the credit sales, this will be equal to 165,750. Okay. Any question, please? No questions? Okay. So now we move on further as to what is a bank credit sales. We have discussed about the traditional method of sales such as cash sales and credit sales. In the modern technological area, the business houses have introduced various methods of payments for the sales made to them. First is cash on delivery, COD. That means you will deliver the goods and the customer will pay cash to you. That is cash on delivery. Okay. Second is acceptance of bank cards. You will give the material to him. Customer will swipe the bank card for you. Bank will process the amount. Bank will keep 1 or 2% with themselves and balance they will remit to you. Or the new types of payments made to them. Let us discuss about the bank credit sales in the section. How the bank credit or debit cards operate. Debit card immediately debits the bank account. Suppose you give the debit card to the merchant, bank swipes the debit card, the bank will check the balance. If the balance is there, bank will automatically debit the bank account. So whatever you will have, it will all go. But if you have the credit card, bank will give you a credit till 30 days. Bank will give you a credit till 30 days. So when the credit card payment will come, and suppose you don't have money, bank will charge the interest from you. Okay. Bank issues the debit card and credit card to the customer. Using these cards, the customer can carry a lot of transactions such as cash withdrawal, online payment, purchase using the card of shops, malls, etc. The bank issued branded credit card such as Visa card, MasterCard, or Masterio card in association with the International Card Associations. So bank issues these Visa card or MasterCard or Masterio card in linkage with these associations. Okay. Acceptance of bank cards are the new type of payments made to them. Let us discuss about the bank credit cards in the section. Bank issues the debit card and credit card to the customers. Using these cards, the customer can carry a lot of transactions such as cash withdrawal, online payment, purchase using the cards at shops, malls, etc. The bank issues a branded card such as Visa card, MasterCard, or Masterio card in association with International Card Association. These cards are valid universally and it helps for compatible payments. So these cards, MasterCard or Visa card, are issued throughout the world. That means not only in India, but they are issued throughout the world. You can get these cards for the international payments internationally also. Okay. The business houses enter into tie-ups with the banks to enable the customers to operate the card transactions with them. Such transactions are known as point of sales transactions. Okay. What are POS? POS are the point of sales. What are these? The bank issues the card to you and you do the transactions. Suppose you suppose you use this card to buy Haldiram sweets 1 kilo or 500 rupees. So Haldiram, you go, you pay, using the MasterCard or Visa card, 500 rupees, the bank will debit you 500 immediately. Okay. So this is known as the point of sales transactions. Okay. Parties to the transactions, cardholder, that means you, the holder of the card, card issuing bank, that means you have issued the card from HDFC Bank or State Bank of India or Union Bank. That is the issuing bank, the cardholder's bank. The bank issues card to the customer in association with the international agencies such as Visa card or MasterCard. Okay. Third is the merchant. That means here it is Haldiram, the party accepting the card payment for the goods sold or the services rendered. Acquiring bank कौन सा होता है? The bank accepting the payment which swipes the card. Okay. आप हल्दीराम जाएंगे, you go to Haldiram, you will, Haldiram person will swipe the card for you. Swipe to his bank. The bank accepting the payment on behalf of the merchant. That is the merchant's bank. The merchant normally have an account with the acquiring bank for the credit of the proceeds. The acquiring bank usually charges fees, normally 1% to 3% from the merchant for these transactions. If you go to a wholesale market, the wholesaler will tell you that we do not use the credit card because they deduct 1% or 3% depending upon the transactions. The operation of the credit card transaction can be represented diagrammatically. Customer to merchant, cardholder bank, acquiring bank. Customer will give the card to the merchant and merchant will swipe the card and the debit will happen to the customer and credit to the merchant. The transactions are customer purchases good from the merchant, customer issues the card to the merchant for the payment, customer will give the card to the merchant for the payment, the merchant swipes the card in the card machine and the customer authenticate the identity with the PIN. This PIN is a control, maker and checker. That is the control. That is, if you give fraudulently someone else's card, the swipe will happen to you, but the message from the bank will go to him. You cannot use others' card. Okay. The card transaction reaches the acquiring bank and forwarded to the approval of the cardholder bank. When there is adequate fund credit in the customer account, the customer bank, the cardholder bank approves the transaction. The funds are transferred from the cardholder's bank to the acquiring bank. The acquiring bank, after the deduction of service charges, credit to the balance of merchant account. So you have understood the flow. This is the flow. Have you understood the flow? Are there any questions from you? Are you understanding this? आपको समझ में आ रहा है मैं क्या बोल रहा हूं? Okay. What are the benefits of card payments? It is more secure mode of payment to a merchant than a check or a draft, because here the check can bounce, but in this case the merchant receives the credit to his account immediately. Immediately he will come to know whether the bank is credited or not. So he can refuse to pay the goods to him. Once he receives the amount, then only he will pay the, he will give the good to the seller, to the buyer. Okay. The amount realized through POS transactions are clearly credited to merchant's bank account. So once the transactions are closed, transactions happen, then the merchant will part with the goods. The customer received is relieved from carrying huge amount of cash to the shops or backwards. Customer has quite a few risks. One of the risk is of cash theft. Customer is prone to the cash theft risk because he carries huge cash. But once he moves to credit card transactions or debit card transactions, he is relieved of that risk. The customer is relieved from carrying huge amount of cash to the shop. He can just carry the card and make the payment. It is a hassle-free transactions. Also, offers of cashback price encourage the customer to use the card effectively. जो इसमें important है, that is very very important, that by using the card he is devoid of carrying huge cash, and he is getting the reward as a payment for credit card transactions. Okay, he gets the huge reward. Okay. Third is it reduces the risk of cash theft and misplacement and is time effective. Fourth is it also served as a evidence for transactions for both the merchant and the customer. That means on that date, at that time, he has done the transactions by noticing that the amount is debited to his account, and on suppose on third day, on sixth day, he will show to the shopkeeper that he has paid the amount to him. So that serves as a evidence to him. Okay. According to bank and cash transactions, accounting for bank and cash transactions, this will go to the bank and cash transactions will go to the cash. A single entry is passed for recording the sales, service fees, and the sales proceed. Suppose on 10th of December, he has done, or various customers have done 10 transactions of credit card, which has resulted in a total sales of 50,000 rupees. So I'll book the entry as bank debit to sales, 50,000 rupees. Clear? Bank debit, and there is a bank service charge which is debited. Bank service charge is debited to sales. Okay. Computation of net sales, cash sales, credit sales, card sales will lead to total sales. Okay, this is gross sales, less sales return, less sales allowances comes to net sales. This net sales figure will go to the P&L. Okay. Do illustration 9 and ask any questions, if any. A company made a sole transaction through card for 76,564. The bank charges are 1.06% service fee. Generalize the transaction. I will give you 3-4 minutes to do the transaction. Yes, please. How many of you have done this question? There will be debit of bank 76,564 less 1.06%, that is 811.47 to sales. I will credit a sales by 76,554 and debit the bank by 75,742.53. Okay. Important is in case of card transactions, the bank does not round off the figure. So you have to give in two decimals figure as the funds are transferred to the merchant account. There is no cash transfer. Hence, students are also expected not to round off the service fees. So please make a note of it that bank service charges will not be round off to the nearest zero, will be round off to the decimals 2 points. Okay. Okay. Managing cash and its importance to the company. So before that, I will like to give you my experience of handling the cash. So in 2000, in 1999 or in 1988, 1998, 1999 till 2000, I was with Modi Xerox. Modi Xerox used to have various locations. बॉम्बे में भी था, दिल्ली में था, पुणे में था, चेन्नई में था, बैंगलोर में था। ऐसे करके उनके 15-20 रीजनल ऑफिसेस होते थे। तो आई गिव यू एग्जांपल, फर्स्ट इन इंग्लिश, देन इन हिंदी। We used to receive checks paid from customer, and we used to receive 36 EMI, 36 or 72, yeah, depending upon the period. So we used to deposit the check. बैंगलोर का चेक है तो डिपॉजिट करेंगे बैंगलोर में, केरला का चेक है तो डिपॉजिट होगा केरला में। सो दैट चेक यूज्ड टू ट्रैवल फ्रॉम द लोकेशन टू द हेड ऑफिस एंड फ्रॉम द हेड ऑफिस टू द रिस्पेक्टिव लोकेशन। एंड वहां पर चेक अगर छुट्टी है उस दिन तो नहीं जाएगा, उसके अगले दिन जाएगा। 3-4 दिन के बाद चेक चेक वो जाएगा, चेक वो ड्रॉप बॉक्स में जाएगा, उसमें क्लियरिंग होती थी, एंड दैट यूज्ड टू टेक 6-7, कई बार तो 2 हफ्ते निकल जाते थे, तब जाके हमें पता लगता था कि वो वाला चेक क्लियर नहीं हुआ है। तो समटाइम्स द चेक क्लियरिंग यूज्ड टू हैपन इन 1 month or 1.5 months. So it was a pain in our ass. So we changed the process whereby we have given the cash का working cycle, यानी कि importance of cash के लिए we have given the cash management का हमने जो पूरा प्रोसेस मोदी ज़ेरॉक्स का वो हमने दे दिया था स्टैंडर्ड चार्टर्ड बैंक को। तो जिसमें कि 2 दिन में हमको क्रेडिट मिल जाता था। तो जहां पर हम महीने लगाते थे, we used to take the months to get the credit, to know whether the customer has given the credit or not. And in this place, we have taken the cash management system from Standard Chartered Bank, who has given us special charges, and the credit was given to us on the second day. Okay, so it was a very, very effective system. Okay, चलिए अब हम समझते हैं meaning of cash and its importance to the company. You will understand, you will define cash and cash equivalents, importance of cash in day-to-day transactions, estimation of cash requirement, and cash break-even point. This you will find questions in the question form, and some questions do come in the exam. For any organization, cash is very, very important. Okay, cash is much important and is the livelihood of the business. Without cash, no business can survive, and it is important component for the working capital. Cash and bank balances are the important part of working capital. Working capital is the amount which gets invested in the business for day-to-day transactions. Net working capital is the difference between current assets and current liabilities. What you will get is net working capital. Current assets minus current liabilities. What you can get is net working capital. And what do you get from the net current assets? The gross working capital. Cash is required for making day-to-day payment, expenses, and to other liabilities. Cash management is an important function of a finance executive. Nowadays, the finance executive is supposed to manage the cash. It involves the forecast of cash receivable and cash to be paid. A efficient and an effective cash budget would help the business to run smoothly without any financial crunch. Cash management is important for only business as it is one for important component of working capital management. So cash is a important part of working capital management. Working capital will have current assets, less current liabilities, and cash and bank balances form a part of your current capital. Okay. It is a beginning and the end of working capital cycle. Cash represent cash and near equivalents. What does equivalents means? Which are readily convertible into cash in the next 3 months. Cash and cash equivalents will have cash balances and FDs which are less than 3 months. Okay. What do you mean by cash? Cash includes money in hand, include petty cash. What is petty cash? Cash which you keep for day-to-day running expenses. Balances which are available in the bank, unutilized bank draft, and marketable securities. This is the meaning of cash. What is immediately converted into cash in 3 months is taken up in cash and cash equivalents. Cash is equal to cash in hand plus cash equivalents. Okay. Cash equivalents are marketable securities, bank balances, etc. What is the importance of cash management? Cash management is a broader term used in dealing with collection, handling, payment, investment of surplus cash to earn adequate returns. यानी कि कैश मैनेजमेंट एक ब्रॉडर टर्म है जो कि कलेक्शन, हैंडलिंग, पेमेंट ऑफ एंड दिस इन्वेस्टमेंट ऑफ, यदि आपके पास सरप्लस कैश है, टू अर्न adequate returns. Okay, you will earn the adequate returns from the business, and the business runs on cash. Cash management aims at positive cash flow. Cash management aims at proper collections of receivables. Receivables के collection हो जाने चाहिए within 30 days. ये cash management का principle है. That is, cash management principle is that cash should be collected of the receivables within 30 days. Second है prioritize over payments and make payment promptly. Why should that be principle? Because if you make payments regularly, the vendor will give the service to you. If you don't make the payment regularly, the vendor will run away and he will not give the service to you. Third is invest surplus cash to earn interest. The components of cash management are collection of cash, concentration of cash, disbursement of cash, and investment of, what do you call it as, surplus cash, this will be invested in investment property. Okay. Goals of cash management: maximize the availability of cash for working capital and long term investment, minimize the risk of insolvency. Third is maintain a company's liquidity and ensure adequate profitability. And fourth is to reduce the period of operating cycle by better cash management. Have you understood this? Oh, the sheet has gone. So can you see the video? Is screen visible to you? Can you see the screen now? Okay. So in between, you have any questions? Any questions, please? Is the point clear? Okay. Goals of cash management. First is that is you will maximize the availability of cash for working capital. You have to ensure that cash is available for you. Okay. Minimize the risk of insolvency. The risk of insolvency will be there once you have less of cash. So that risk has to be removed. Maintain a level of company's liquidity and ensure adequate profitability. That is the third. And reduce the period of operating cycle by better cash management. Okay. So you have four goals of cash management. Managing cash flow is an important function of business managers. Cash flow represents the movement of cash into and out of a business. There may be a situation of positive cash flow and negative cash flow. So what is a positive cash flow? That means cash inflow is more than cash outflow. That is a positive cash flow. And what is a negative cash flow? That cash outflows are more than the cash inflows. Okay. So any questions, please? So 5:57. So thank you very much for your time. Have a nice day. Thank you. Bye bye.